Hey, welcome back everyone. Here's my personal capital dashboard. I've linked all of my accounts, my retirement, my taxable accounts to this particular platform, and it shows me my total portfolio value at the top left. I just crossed over $129,000 and I'm kind of steadily watching the markets here. My particular performance to date, you can organize the dates here on the right side. My index or my total portfolio is up 1.64% from year to date. Year to date, the S&P 500 index is actually down only 1.56% as of June 9th, 2020. Year to date, the NASDAQ 100 index is up 12.341%. You can see the US stock market here, foreign stock market, and the US bond market. I'm going to just give a little quick update on my holdings. QQQ is in my Vanguard taxable account. Value is on the right side here. I own 61.06 shares. This next one, FXNAX, is my Fidelity 401k, and that's the bond index. US bond index, total value over there on the right side. We're going to skip this particular American funds one. It's a part of an IRA. I figured I'd just keep it around instead of transferring it over to Vanguard just to see the difference in performance. This next one here is my Roth IRA at Vanguard, VWELX, the Vanguard Wellington Fund. Total balance over there is $15,937. Again, another American funds IRA fund. It's a target date retirement fund, and I'm just keeping it around to see my performance compared to how my other Vanguard accounts are doing. This here is my other Fidelity 401k fund. It's the FXAIX fund, or the 500 S&P 500 basically, and a total balance of $32,000. What I did recently was sell some bonds shown here in the US bond index in my 401k, and I bought shares of the S&P 500 index fund. And the reason is I realized I have too much exposure to bonds for my age, and maybe we can call it a sense of FOMO, a fear of missing out, and it got the better of me. So I went ahead and I rebalanced. So I sold off about $10,000 worth of the bond fund and I bought the index fund. We'll see how that turns out. You know, the market is recovered, and so I'm not sure what the future holds, but with a long time frame, I know that this decision makes more sense for me as a 30-year-old. Below that here is VXUS. And this is part of my Vanguard taxable account. And below that is the Vanguard Dividend Growth Fund, another one of my funds in the taxable side on my Vanguard taxable account. And last but not least is one particular stock in my Fidelity HSA or health savings account that was opened for me by my previous employer. So that's less than 2 shares, $205 right now. That's my only stock pick. If you look at my previous videos, I have had individual stocks, but I've really honed my strategy and focused on the long-term data that stock picking, it just doesn't really work out for 80 to 90% of people. And I know I'm not special, and I don't have a team of analysts checking on, you know, the pulse of the market, what's going on in different trends and momentum factors and whatnot. I really have lost interest in keeping track of different individual stocks, which is why I've sold off all of them except, you know, I'm going to hold on to WM Waste Management for life, and I'll just stay in my health savings account. I'm not on a high deductible plan, so I'm not eligible to contribute to an HSA. So this particular one stock will just stay there. Let's see now. My favorite view in Personal Capital is my allocations tab. Gives me a nice graphic of how I'm allocated across my buckets of cash, US stocks, US bonds, international bonds, and international stocks. So if we scroll down here, you can see I'm still pretty heavy with about 31% cash, over $40,000. International bonds, you can see that US bonds, international stocks. US stocks is very heavy, so I am trying to build out my international stock position while reducing my cash position. So the high amount of cash does allow me to sleep at night. It's important to pay attention to your tolerance for risk. As your portfolio size grows and your goals change, you learn a lot more about yourself when you experience paper losses. This is what makes me comfortable right now. I'm sticking to my plan, but I did experience a bit of FOMO, which is what this video is about. And I sold off some bonds and I've bought shares of stocks. And that was in my Fidelity 401k. In its most literal meaning, FOMO is the fear of missing out. And in terms of behavioral economics within the investing realm, the psychology behind FOMO can be explained by the fear of loss aversion, which means needing to jump in on the bandwagon so as not to get left behind. There's research that suggests the feeling of losses are twice as impactful as gains. We just hate to lose out on anything. And I felt this feeling with the Federal Reserve printing money, people like Ray Dalio saying cash is trash. We don't really know what's going to happen in the short term with the lockdowns possibly continuing, with a higher spike in different cases of the sickness going around. We see the stock market climbing up, especially the NASDAQ hitting all-time highs after such a severe and rapid drop in price. So we want to jump on board and buy the next hot stock. So even though I felt the need to sell some of my bonds within my 401k and buy shares of the S&P 500 index fund, I know that I'm sticking to a plan. And that's one way to counteract FOMO, is to have the goal in mind, whether that's a number, whether that's an asset allocation of your stocks to bonds. Creating that basic strategy will help you meet your goals. I am maintaining a specific level of cash, reducing my bonds because I have that cash buffer, and I'm increasing my stock allocation. My retirement accounts are all on auto invest. I'm also executing auto contributions within my taxable accounts. Another way to combat FOMO is to focus on the long term and to be patient. Most serious investors know that investing for wealth is not a sprint, it's more of a marathon. It takes a long time to build wealth. So with that lens, you can push your time frame out and rely on market returns through index investing. Remove the stress of stock picking, for example, and you can reduce the amount of FOMO. Confirmation bias refers to a type of selective perception that emphasizes ideas that confirm our beliefs while devaluing information that goes against our beliefs. As humans, we want to believe what we think is correct, and we're going to seek out information that supports our beliefs instead of perhaps seeking information that contradicts our beliefs. One way to combat confirmation bias is to recognize it while it's happening. Another way to combat confirmation bias is to intentionally put more weight on contradictory information than you typically tend to do. You can try to play devil's advocate with yourself and make a case of how this contradictory information could be correct. After this process of contradicting yourself and seeking contradictory data, but maybe not finding compelling data, then go with your original view as still valid, and you can proceed with your course of action or strategy. So here we are in my M1 Finance taxable account. M1 Finance is a commission-free brokerage that offers fractional share ownership of stocks and ETFs. You're able to invest exact dollar amounts, so it's perfect for someone who's just starting out and, for example, can't afford a full share of Amazon, if that's something that they want. So right now I have $500 in this particular taxable account. I don't have any money currently invested. I started this account on April 15th, 2019. Since that time, I have a net realized loss of $915. I was able to reduce my taxable income for my 2019 taxes, and I'll also be able to reduce my taxable income in 2020 when I'm filing my tax return in 2021. Tax loss harvesting is a concept I can explain in a different video, but long story short, if we look at my funding history, I contributed quite a bit of money in 2019, but then I also withdrew a bunch of money in 2019, and then I continued to withdraw in 2020. The reason is I was picking all kinds of different stocks in my M1 Finance account, and after further research, after learning more about myself, learning about investing through my colleagues at work, stock picking just isn't for me, and I really want to continue building out positions in my broad index funds. So I'm starting fresh with $500, and I'm going to be auto investing $100 every single Monday, and hopefully for the rest of my life. So let's build this particular pie that I have in mind. We're going to click on edit. We're going to remove this pie that was in there. We're going to add my two funds that I'm interested in. Funds. And you can see QQQ, which is the NASDAQ 100 Index Fund. We're going to also add VXUS, which is the Vanguard Total International Stock Market Fund. Add to basket. We're going to click add there. And this is a self-preference thing, but I want 80% in the QQQ fund, and I want 20% in VXUS. We've called it Chase's Pie, and we're just going to click save here. You're going to have to do your own research about these two different funds, but in previous videos I have explained that QQQ tracks 103 different companies, all market cap weighted, so it's very heavy in the FANG M stocks. That's Facebook, Apple, Amazon, Netflix, Google, and Microsoft. And other names include Zoom, Tesla, PayPal, Activision, Blizzard. The list goes on. With VXUS, that's tracking several thousand different international-based companies. And the reason why I chose 80/20 is all self-preference. The international stock market has outperformed the US stock market in different decades. The most recent decade, tech stocks and growth stocks have really taken off, and I, for one, think that tech will continue to be one of the driving forces of the stock market, and that's my own bias, that's my own lens. So with auto invest turned on, this particular $500 that's sitting in my cash balance will be invested in 80% QQQ and 20% VXUS starting tomorrow. And every Monday I'm auto investing $100, and this particular pie that I've built will be with me for the rest of my life, hopefully. I don't intend to sell. I'm just going to continue to buy, and this will be for the long term, and this is one of my taxable accounts. So to recap really quickly, this M1 taxable account that I started in April 2019 was a fun play account, and now with the knowledge that I've gained over time, I want it to be an extension of my broad index funds, which is why I've invested into QQQ and to VXUS. Auto invest turned on, and I want to just set and forget. Takes the emotion out of everything, and I know that over time, as long as these companies continue to innovate and produce goods and services that people benefit from, the share price will increase. I'm not interested in tracking dividends. I don't need current income. I know that dividends are very important to certain people, but it's so important to not lose sight of the forest for the trees, and 80 to 90% of stock pickers tend to underperform just a basic S&P 500 fund. The reason why I'm not investing in the S&P 500 in this taxable account is because in my Fidelity 401k through my employer, I'm already plowing in so much money into the S&P 500 fund that I have there, and I keep all my bond exposure in my retirement accounts because they produce ordinary dividend income I really hope you enjoyed today's video, and until next time, thanks so much.